Welcome back to my channel. This is a 4-session part on corporate governance and the King Code. We are going to be continuing on from where we left off in video 2. So if you haven't watched video 1 or 2, please go back and watch those videos and then you can come to this one. So in this video, what will we be doing? We will be looking at principles 8 to 10 in the King Code. We will be attempting to understand what is the contents of the King Code, but also how do we apply what we learn in the King Code, particularly for principles 8 to 10. As mentioned previously, principles 8 to 10 is the business end of the King Code, meaning that this is where the majority of the marks come from during assessment. So you should pay particular attention to what we mention and what we speak about here so that you are able to score well in your upcoming assessments. So let's get straight into it. This principle is broken up into 6 different parts. The first part is general. In the general part, it is emphasized that the governing body may, if required, create what is called an ad hoc committee. That is a committee that is only in existence for particular reasons. This section gives guidance on how the governing body should go about creating such a committee. For example, terms of reference need to be created for such ad hoc committees. That means that we indicate what exactly is being delegated to the committee. We also want to explain the detailed responsibilities of each committee member as well as the committee in general. We want to provide formalization for the committee, meaning that there's a formal charter or formal terms of reference, and we want to ensure that the roles and responsibilities of the committee are clearly outlined. This ensures that we are able to keep the committee accountable to whatever they are required to do. For example, in the terms of reference, we will set out what are the roles and responsibilities, what are the authorities that the committee has, what decisions the committee can make, and if the committee is a temporary committee, we also need to indicate how long the committee will be in existence for. For example, the governing body can indicate that each committee needs a minimum of 3 members. This is recommended so that the committee has the sufficient number of staff in order to execute its duties. Generally, with an ad hoc committee, any member of the governing body can attend, including management, by invitation. Members of the governing body are allowed to attend such committee meetings to ensure that their responsibilities are being discharged. You also have to keep in mind that the entire committee is made up of governing body members. The responsibility of the individual subcommittees ultimately lies with the governing body. Therefore, they need to ensure that the responsibilities and duties of each subcommittee is being discharged. There needs to be public disclosure about the roles, responsibilities, and actions of each subcommittee. Next, we'll be moving on to the audit committee. So what is the purpose of the audit committee? This slide will detail only the purpose of the audit committee, and the following slides will detail the composition and disclosure of each audit committee. The purpose of the audit committee is to ensure that good financial reporting is practiced at an entity. This ensures that financial reports have good integrity and that there's constant assurance, both internal and external, on these reports. This means that the governing body may delegate the requirement of creating and compiling financial reports and other external reports to the audit committee. It is also common for the audit committee to be in charge of identifying risks, both financial, business, and audit risks when compiling such reports. This is because such information will be freely available to the audit committee. Therefore, they are in the best place to identify such risks. As a result, you will often find in practice that audit committees are referred to as audit and risk committees. This committee is expected to meet at least annually with both the external and internal auditors. When this meeting takes place, they must ensure that management is not there because management may intimidate such assurance givers. Let's move on to the composition of the audit committee. When deciding on who should be part of the audit committee, it is important to note that we want to get people that are skilled and able to execute the duties and responsibilities of the audit committee. As a result, the King Code specifically indicates that they must be financially literate and have skills and experience in financial reporting. Also, because assurance is such an important part of an entity's reporting, we have to ensure that all members of such committee is independent, particularly of the entity. As a result, only independent non-executive members of the governing body may be appointed to this committee. Seeing that only independent non-executive directors are making part of this committee, it's no wonder that the chair also needs to be an independent non-executive director. This committee also needs a minimum of 3 people or 3 members. Let's move on to disclosure of the audit committee. There is sometimes need for general assurance matters to be disclosed, such as errors that may be found or the opinion that is disclosed by the external auditors. Independence of the external auditor needs to be specifically addressed in the disclosure of the audit committee. Also, if there are any significant matters listed by the auditor in their audit report, it's normally listed as key matters. The audit committee should address these with significant amounts of disclosure and explanation around them. Audit quality and auditor independence go hand in hand, and as a result, the audit committee should give some sort of comfort to the reader that the audit quality and audit independence go hand in hand. Therefore, the audit committee is required to give some sort of assurance to the reader of the financial statements that the external auditor has upheld good audit quality. The internal auditors, as well as the chief assurance officer, all report to the audit committee. Therefore, the audit committee is required to assess the performance of such individuals and give disclosure on their performance. The audit committee is also required to assess the performance of the chief financial officer and the finance department in general. This may mean doing an assessment of what work was completed and the efficiency of such work being completed. Let's move on to our third point under Principle 8, the Nominations Committee. Particularly, what is the purpose of the Nominations Committee? So, as you very well know, governing body members are only selected by shareholders. But in order for the shareholders to know who to select, the Nominations Committee will shortlist specific people that may become potential members of the governing body. This is the main purpose of the Nominations Committee. It is to nominate someone to be part of the governing body. Therefore, their role is to oversee the nomination and election and appointment process of governing body members. Their role also extends into ensuring that there is a constant leadership at the entity. This is sometimes called succession planning. And finally, they will be required to evaluate members of the governing body and their performance. Who should be part of this committee? There is required to be non-executive members on this committee. Notice also that the chair of the governing body may be a member but may not chair this committee. The majority of these members must be independent. What needs to be disclosed? The committee must disclose the roles and responsibilities as well as the composition of its own committee as well as the governing body. Fourth on our list is the Committee for Risk Governance. As mentioned previously, this committee is normally combined with the Audit Committee. This committee's main purpose is to oversee risk governance at the entity. This means that they need to be aware of specific risks that may arise as well as potential threats to the entity's future. Who should be part of this committee? There should be a minimum of 3 directors that must be part of this committee. It is encouraged that these members also have a joint membership on the Audit Committee. As a result, we say that there is normally an Audit and Risk Committee. There may be both non-executive and executive members in this committee. However, the majority of the members on the committee must be non-executive. Notice that it does not place the requirement of being majority independent. However, that is more favorable. It is important to note that the chairperson of the governing body can be the chairperson of this committee. However, they cannot be the chair of the Audit Committee. So if the 2 committees are combined, we must use the more restrictive requirement. The governing body will also be tasked to assess the performance of such a committee. What needs to be disclosed? The roles, responsibilities, and commission of this committee should be disclosed, as well as potential risks and areas of focus. For example, a summary of the risk assessment of this committee can be disclosed to the public. This must ensure that risks are not made obvious so that competitors cannot take advantage. However, it must also ensure that the public are able to understand what risks face this entity. Let's move to number 5, the Remuneration Committee. The purpose of this committee is to ensure that there is sufficient oversight over the remuneration of not only directors but individual employees at the entity. The governing body may add or subtract from the roles and responsibilities of this committee. All members of this committee should be non-executive directors of the board, and the majority of them must be independent. The chairperson of this committee must be an independent non-executive director. In addition, the chairperson of the governing body cannot be a member of this committee. What does this committee need to disclose? This committee needs to disclose their composition, including their roles and responsibilities, what they focused on for the given financial year, and how they were able to satisfy their duties. The Social and Ethics Committee. The Social and Ethics Committee has a purpose to oversee an entity's organizational ethics. They are responsible for ensuring that the entity is a good corporate citizen. Sustainable development and sustainable development reporting is in the ambit of this committee's responsibilities. The entity also takes care of stakeholder relationships. Sometimes the entity may have statutory duties or legal duties that are imposed by the Companies Act. What is the composition of this committee? This committee may have both non-executive and executive directors. However, the majority of directors must be non-executive. This committee, like other committees, must disclose their roles and responsibilities, their composition, what they focused on in the financial year, and how they satisfied their duties. Let's move on to Principle 9. Principle 9 concerns itself with evaluations of performance of different board members and board committees. This simply means that the entity must continually evaluate themselves and assess their performance, ensuring that no specific person laxes in his responsibilities. The governing body as a whole must assume responsibility for the evaluation of its own performance, the performance of its chairpersons, and individual members of the governing body. If an independent non-executive director was not appointed as the chair, a lead independent non-executive director will be appointed to assess the performance of both the governing body as well as the chairperson. Such an evaluation needs to happen every year, but on every alternate year, so every 2 years, an externally facilitated performance evaluation should take place. This is recommended by the King Code. The methodology as well as the process of such an evaluation will be approved by the governing body as a whole. If we are in the alternate year where no external evaluation is taking place, the governing body is required to reflect upon their own performance. They need to indicate how their performance has added or achieved the plans that they had set out to achieve. With regard to disclosure in this principle, the governing body needs to disclose what performance evaluations were completed during the year, what was the scope and formality of these evaluations, as well as the results. If they were found to be lacking, they also need to indicate what remedial actions will take place. Let's move on to Principle 10. Principle 10 concerns itself with the delegation powers of the board, meaning what can the board of directors or governing body delegate to management. Because the governing body is not there on a daily basis, it is important for them to delegate certain key responsibilities to management. One of the most important players in management is the CEO or Chief Executive Officer. This principle will focus in solely on his responsibility. For example, the Chief Executive Officer is required to lead the approved strategy that the board has put in place, including operating planning and performance of the entity. Note that the CEO should not be the chairperson of the governing body. Remember also that the chairperson of the governing body needs to be an independent non-executive director. And because the CEO is an executive, we already should not be having that person. The CEO also should not be allowed to be a member of the remuneration, nominations, or audit committees. This is because that would give the CEO far too much power over the integrity and reporting of the entity. The governing body should always consider other appointments that the CEO may hold and consider whether the CEO still has enough time to execute the duties that he is responsible for as CEO of the entity. Because the CEO is an integral part of the entity, The governing body must ensure that this position is never left vacant for too long. This requires a succession plan. The governing body is required to evaluate the performance of a CEO. This means that the CEO must have agreed upon measures that they will be measured against. The board of directors will discuss the formalization of such a methodology that ensures that the CEO is accurately evaluated. This evaluation should happen at least annually. With regard to disclosure, the CEO should be freely contactable by investors as well as the public. As a result, the contact details of the CEO through the entity should be made public. Any other professional commitments as well as appointments that the CEO holds should also be made public. And the need for succession plan. After having dealt with the appointment of the CEO, let's deal with delegation. The governing body is required to delegate certain roles and responsibilities to management. However, this does not relieve the governing body of its accountability to stakeholders. In order to ensure that the governing body's power is not abused, the governing body should clearly indicate what roles and responsibilities it is going to delegate to management. This should be formalized by a document called the Delegation of Authority Framework, in which each and every task that is delegated to management is indicated, and the authority or power that they have over that task is also indicated. This will ensure that executives of the entity do not overreach their power. The board is still required to oversee certain key aspects of the entity, such as risk management, ethics, and human resources. On an annual basis, the governing body must report back to indicate what authority has been delegated to management. And if there are any changes to the authority that has been delegated, that also needs to be indicated. Next, we'll deal with the role of the company secretary. Now, the company secretary is not a normal secretary that you may know of. Instead, a company secretary is a legal advisor to the governing body. The governing body is required to seek legal advice. The company secretary may also assist with corporate governance matters. Now, the reason why they go to a company secretary is because this is generally a skilled lawyer who will understand the legal ramifications of the actions. Not all members of the governing body may be skilled in law, so as a result, a company secretary is required. When appointing a company secretary, the governing body should approve all arrangements for services, so indicating the specific services that are required. They also should ensure that the company secretary has the required authority and authorization in an entity to make sure that they are able to do their job. The board should approve the remuneration of such a company secretary and ensure that the company secretary is competent to execute their duties. This may mean that the company secretary has to go for an interview. The company secretary should have unrestricted access to the governing body. The company secretary reports directly to the governing body. Notice that the company secretary is not a director. However, they are a prescribed official officer. When we go over the Companies Act, later on in the year, pay particular attention to the role of the company secretary. As mentioned previously, the company secretary reports directly to the board of directors. He or she is not a director, but the independence of the company secretary needs to be evaluated on an annual basis. Thank you. That brings us to the end of Principle 10. We have now completed 3 videos on corporate governance and the King Code. Please stay tuned for video 4.